Thank you very much for taking time to listen to this message today. I am Katoka, Representative Director, President, and CEO. From now, please let us explain the financial results for the first quarter of the fiscal year ending on January 31st, 2027. To begin, we would like to share the three key takeaways from today's presentation. First is our financial results for the first quarter of the fiscal year ending on January 31st, 2027. Adjusted metrics reflect the intrinsic performance of our existing businesses, excluding one-time M&A related expenses. Adjusted EBITDA reached 4.61 billion yen, and adjusted net income came in at 730 million yen. On a consolidated basis, all metrics achieved our initial targets. Upside in our domestic amusement business and other segments absorbed the underperformance of our overseas business. Second, let us explain the progress of our North American business. First quarter earnings performance fell short of our initial plan, prompting us to revise our full-year forecast for North America. However, this will be absorbed by our domestic business, and our consolidated full-year forecast remains unchanged. The underperformance was primarily driven by lower visit frequencies, which caused revenues to fall below the break-even point and allowed fixed costs to weigh on earnings. Additionally, costs increased due to the concentration of one-time integration expenses in the first quarter, alongside the accelerated rollout of new store openings and the add-on initiative ahead of our initial schedule. From the second quarter onward, we anticipate revenue growth driven by our initiatives to increase visit frequency. While our results were heavily impacted by a sharp decline in February prior to these measures, visits have been on a recovery trend throughout March and April post-implementation. This has outperformed typical seasonality, and we will continue to strengthen these measures moving forward. Additionally, we expect one-time expenses to taper off, while new store openings and the add-on initiative executed in the first quarter will begin delivering full-year contributions. Furthermore, we anticipate revenue growth driven by the rollout of IP merchandise and figurines. Third, we would like to explain the progress of our domestic business. Our amusement business exceeded targets against our initial plan. We are driving same-store sales growth by attracting urban foot traffic with Gigo exclusive prizes, while simultaneously accelerating growth in suburban and shopping center locations through store format conversions into claw machine specialty stores. Our karaoke business is generally progressing on track. In facility operations, karaoke venues continue to see resilient consumer demand, while our equipment distribution business is securing stable, recurring revenues. Additionally, we are currently optimizing our cost structure through the ongoing implementation of DX initiatives. Our tourism business is generally progressing on track. Older money exchange machines installed over 10 years ago continue to contribute to earnings, forming a stable, recurring revenue base. Furthermore, the number of installed units, which has expanded significantly since joining Genda, is progressing in line with our plans. We would like to explain the first quarter earnings results. Starting from our full-year financial results for the previous fiscal year, we have been disclosing adjusted metrics, positioned as key performance indicators, KPIs, as non-GAAP financial measures in our earnings releases. Adjusted metrics reflect the intrinsic performance of our existing businesses, excluding one-time M&A related expenses. This ensures consistency with our full-year forecasts, which, starting from this fiscal year, will be disclosed solely on an adjusted basis. Our adjusted net income is calculated by adding back the amortization of goodwill and M&A-related intangible assets. Consequently, the impact on this metric will be minimal, even after our transition to IFRS, allowing investors to continue tracking it as a consistent baseline. Here is the summary of our consolidated statement of income. For the first quarter of the fiscal year ending on January 31st, 2027, financial results landed above our initial plans across all metrics, with revenue reaching 49.7 billion yen, adjusted EBITDA at 4.6 billion yen, and adjusted net income at 700 million yen. Additionally, our domestic amusement same-store sales recorded another quarter of high growth. Next, we'll review our quarterly trends and target variances for the fiscal year ending on January 31st, 2027. As announced in March, Our target for this fiscal year remains back half weighted for both revenue and earnings. In terms of revenue, the numbers will scale up toward the back half of the year, moving from a first quarter result of 49.7 billion yen to planned targets of 58.5 billion yen in the third quarter and 57.7 billion yen in the fourth quarter. On the earnings side, adjusted EBITDA is also projected to nearly double, rising from a first quarter result of 4.6 billion yen to a fourth quarter plan of 9.7 billion yen. This trajectory accounts for the seasonal nature of our operations, and progress remains fully in line with our initial targets. Looking at the breakdown by segment, the overall picture shows that strong performance in domestic amusement absorbed the underperformance of our overseas business. In our domestic amusement business, Gigo exclusive prizes successfully drove foot traffic to our urban locations. Additionally, our strategy of converting suburban and shopping center locations into claw machine specialty stores paid off, allowing us to exceed our initial plan. Our overseas amusement business fell significantly short of our initial plan. The primary cause lies in North America, the details of which we will explain shortly. Europe, we incurred increased costs associated with the carve-out of Genda Play Nation. However, these expenses are expected to taper off from the second quarter and resolve entirely by the fourth quarter. Meanwhile, China exceeded its plan, driven by strong performance from new store openings and equipment sales. Our prize-related karaoke and tourism businesses all progressed generally on track. In other business segments, cost optimization efforts at Photo Studio Carrot proved successful. Additionally, Gaga's North American distribution of the movie Umamusume, Pretty Derby, Beginning of a New Era, was highly well received, driving performance above our initial plan. Next, we will walk you through our balance sheet. Total assets have expanded to 224.8 billion yen. Regarding goodwill, we continue to maintain a comfortable safety buffer of 15.3 billion yen relative to net assets. Our net debt to EBITDA ratio stands at 2.8 times, leaving ample room for additional borrowing. As we shift our strategy toward generating positive free cash flow, FCF, the debt level of our existing businesses has begun to decline. Combined with our back half-weighted cash generation, our overall debt capacity is set to improve even further. Furthermore, we maintain high liquidity with a liquidity ratio of 144%, securing approximately 31.6 billion yen in cash and liquidity against roughly 21.9 billion yen in interest-bearing debt, effectively due within 1 year. Next, let us explain our North American business. In light of the margin of underperformance against our initial plan, we've revised our full-year forecast for the North American business. However, this shortfall will be absorbed by our domestic operations, leaving our consolidated full-year forecast unchanged. In the first quarter, our North American business fell short of its initial target. While revenue achieved its target on a yen basis due to foreign exchange tailwinds, it underperformed on a dollar basis. The primary cause of the underperformance was a decline in the number of site visits by our field merchandisers, rounders. Following the integration of 5 North American entities into our CCX management system, the unexpected burden of cash collection tasks caused site visits to drop by approximately 40% compared to pre-integration levels. The impact was particularly severe in February, prior to implementing countermeasures, with revenues continuously falling below the break-even point. However, since launching recovery initiatives in March, which included eliminating bank deposits and introducing Kittleton Force, our AI-driven operational app, visit frequencies have entered a recovery trend and have been on a full-scale recovery trajectory since April. On a monthly basis, you can clearly see that revenue, EBITDA, and net income are all on a recovery trend from February through March and April, directly correlating with the increase in site visits. The positive impact of our strategic measures is now tangibly reflecting in our financial numbers. Here is a year-over-year comparison. In February, because our Kittleton Force and other initiatives had not yet been deployed, revenue was significantly down compared to the same period last year. However, while revenue typically declines from March into April due to historical seasonality, as seen last year, This year, we achieved a sequential revenue increase over that same period. This clearly demonstrates that the positive impact of our operational improvement measures is successfully outperforming the downward pressure of typical seasonal trends. The second factor behind the shortfall was the concentration of one-time integration expenses and front-loaded growth investments. One-time expenses related to the North American integration of Kittleton, Nen, and Player One were heavily concentrated in the first quarter. In addition, new store openings and the add-on initiative progressed faster than planned, leading to front-loaded launch costs. However, this successfully builds a stronger revenue foundation for the future. Looking ahead, these one-time integration expenses will taper off starting in the second quarter and are expected to resolve by the fourth quarter. Concurrently, we are pursuing permanent cost improvements, such as streamlining redundant functions through system integration and consolidating warehouses. Furthermore, the upfront costs from accelerated store openings and add-on will transition into a recovery phase from the second quarter onward, with this accelerated expansion accumulating as a solid revenue base throughout the rest of this fiscal year and into the next. As an additional measure, we are expanding credit card payment options to raise spend per customer by upgrading Play pricing, alongside deploying payment terminals with superior UIs. Pilot stores have already delivered highly promising results, with revenues increasing by an average of 17%. Next, let us review the status of our new store openings and the add-on initiative. In terms of unit count, new store openings are progressing at a pace significantly ahead of plan, reaching 213% of our initial plan. Our add-on initiative is also tracking well, at 103% of the plan. On a revenue basis, both measures are outperforming our target, with new store openings achieving 135% of the target and the add-on initiative reaching 117%. As a key differentiation strategy in North America, we are accelerating the rollout of Japanese IP branded merchandise. Following the launch of 12 major Japanese IP titles in the first quarter, we plan to sequentially deploy additional titles from the second quarter onward. In particular, the highly anticipated introduction of minifigurines marks the official launch of our strategic marketing initiative designed to shift the local market. Rather than relying on casual visitors, this is explicitly aimed at cultivating destination-driven customers in North America, mirroring our successful Gigo exclusive prize strategy in Japan. We will roll out our strategy in phases, beginning with comprehensive consumer research across North America to map out regional fan demographics. This will be followed by establishing tailored channel strategies for our core fan base and ultimately executing multi-dimensional digital marketing initiatives. From here, we will explain the progress of each domestic business segment. The primary driver behind our same-store sales growth in domestic amusement is our Gigo exclusive merchandise. By collaborating with highly buzzed-about IP titles, we continuously generate strong reasons for fan bases to visit our locations. As a specific example, we held a pre-release campaign for Ensemble Stars, exclusive prizes at 3 of our Ikebukuro stores, drawing a massive turnout of fans from day one. Our primary strategy for boosting sales at suburban and shopping center locations is converting them into claw machine specialty stores. Because this approach focuses on remodeling existing stores rather than constructing new ones, we can revitalize our capacity to attract foot traffic with limited capital expenditure. Following these format conversions, individual store sales have surged by anywhere from 2.2 to 10.3 times, with converted locations operating for 3 months or longer, achieving an impressive average sales growth of 3.1 times. As one of Japan's largest amusement arcade operators with an extensive suburban store network, we believe the potential to scale these low-investment format conversions represents a massive growth opportunity for us. We have reviewed the investment recovery performance of the 15 M&A transactions executed to date within our domestic amusement business. Excluding Sega Entertainment, the cumulative investment for these 15 transactions totaled approximately 15 billion yen, achieving a cumulative payout ratio of 37% as of April 2026. This rapid pace of investment recovery is driven by a combination of disciplined acquisition pricing and accelerated growth fueled by post-acquisition synergies. Our karaoke business progressed generally on track with our initial plan. In our karaoke facility operations, customer volume increased year over year, driven by the promotional discount event celebrating the 400th store for Karaoke Bam Bam. Our IP collaboration campaigns also contributed to lifting both customer traffic and spend per customer. Meanwhile, the karaoke equipment distribution business remained robust, supported by a stable recurring revenue model driven by cumulative rental income. The PMI for our karaoke business is centered on driving profitability improvements through DX. In our self-checkout pilot program, 16 designated high-efficiency stores successfully reduced labor costs by 2.9% year over year, while simultaneously capturing an 8.3% year-over-year increase in sales. This system is currently active across 34 locations, and based on these pilot results, we plan a full-scale rollout starting next fiscal year. Additionally, within our karaoke equipment distribution business, we've launched InMeNavi, our proprietary customer relationship management system aimed at enhancing sales efficiency and the precision of our client proposals. Our foreign currency exchange machine business continues to demonstrate powerful growth, with the transaction payout volume achieving a CAGR of plus 83% from the fiscal year ended on January 31st, 2023 through January 31st, 2026. Since joining Genda last year, the network of installed machines has expanded significantly. This steady expansion has continued into the fiscal year ending on January 31st, 2027, and we are currently on track to reach a scale of 1,500 units by the end of the fiscal year. Crucially, even older machines that have been installed for over 10 years remain fully operational and continue to contribute to profitability, forming a highly stable, recurring revenue base. In response to strong interest from our investors, we are pleased to begin disclosing our data book starting this fiscal year. The data book includes quarterly trends for various KPIs, as well as metrics such as ROIC and ROE, and is available on our IR webpage in both Excel and PDF formats. That concludes today's explanation. Toward our vision of becoming the world's #1 entertainment company in 2040, Genda will continue to drive forward without losing momentum while ensuring sustainable growth in lockstep with the capital markets. We thank you for your continued support and look forward to sharing our journey with you.